The 50% capital gains tax discount that's been in place since 1999 is almost certain to be reduced in the May 12 budget. The Senate report is in, Labor has sided with the Greens, and Treasury is working up the numbers. So the question isn't really whether it's happening anymore, it's how much it's changing and whether it applies to assets you already own. My prediction is a reduction to 33% across all assets, effective from the announcement on budget night. And if I'm right, the window to sell anything under the current rules is closing fast. But the bigger story here isn't just that you'll pay more tax. When you look at what the new effective tax rates actually are, they end up above the company tax rate, which flips the conventional advice about where you should be holding your investments. So I want to show you the actual maths, what it means for you, depending on your situation, and why this change might be the trigger to rethink your structure entirely. The CGT discount has been around since 1999 when Peter Costello replaced the old indexation inflation method. Before that, you had to adjust your cost base for inflation every year that you held the asset, which was complicated. The 50% discount simplified everything. Now, a Senate committee has just handed down a report with Labor and the Greens agreeing that the discount has skewed housing ownership towards investors and away from first home buyers. Treasury is working up options for the budget, and the numbers being talked about are a reduction to somewhere between 25 and 33%. The government is framing this as an intergenerational fairness issue. Young people can't afford to buy homes because investors are outbidding them at auctions. And the CGT discount makes property too attractive as an investment. And look, housing affordability is a genuine problem. No one's arguing that. But here's what you need to understand about why Australians invest in property in the first place. It's not because of the CGT discount. It's because income tax rates in this country are so high that people will do almost anything to pay less tax. If you're earning $135,000, every dollar after that is taxed at 39%. And once you hit $190,000, it goes to 47%. So what do? You buy an investment property that loses money. Claim the loss as a tax deduction through negative gearing, and then when you eventually sell, you pay less tax on the gain because of the discount. The real problem here is bracket creep. Tax thresholds haven't kept up with inflation, so ordinary income earners are paying tax rates that were designed for high income earners. And instead of fixing that problem, the government is reducing the one concession that made investing worthwhile while leaving the underlying problem completely untouched. In my opinion, this is a revenue grab dressed up as a housing solution. But whether I agree or not doesn't really matter. It's coming, so let's look at what it actually means for you in dollars. So let's use the top income tax rate of 45% plus the 2% Medicare levy, because if you're making a large capital gain, even if your salary isn't that high, the gain itself will push you into that top bracket. Right now, with the 50% discount, you only pay tax on half the gain. At 45%, that gives you an effective tax rate of 22.5%. Add the 2% Medicare levy and you're at 24.5%. Now, let's say they reduce the discount to 33%. You're going to be paying tax on 67% of the gain instead of 50%. And at the top tax rate, that's 30.2% plus the levy, so 32.2%. And if they go to a 25% discount, the effective tax rate lands at 33.8% plus the levy, so 35.8%. So no matter which of the proposed rates they land on, your effective tax rate on capital gains as an individual ends up above 30%. And that changes the conversation about where you should be holding your investments, because the company tax rate is only 30%. Now, if you ever asked your accountant whether you should hold investments in a company, the answer has probably been no. And the reason is simple. Companies don't get the CGT discount. So when the discount was 50% and your effective personal tax rate was 24.5%, why would you use a company and pay 30%? But look at those numbers again. At the 33% discount, your personal tax rate is 32.2%. At 25% discount, it's 35.8%. So the gap that justified holding assets personally has either closed or flipped entirely. So the maths is shifting. But what you do about it depends on where you're at right now, because not everyone is in the same position. If you're a business owner investing surplus profits, this is where the bucket company structure becomes really hard to ignore. The way it works is straightforward. Instead of pulling profits out of your trading company, paying up to 47% personal tax, and then investing what's left in your own name or a family trust, you distribute the profits across to a separate investment company. That company pays 25 to 30% tax on those profits, and the rest stays in the company working for you. You control where it's invested, and because you paid less tax on the way in, you've got significantly more capital compounding from day one. The old argument against this was, but you can't get the CGT discount when you sell. And when the discount was 50%, that was a fair point. But as we've just seen, that advantage is either gone or close to it. Using a company, you're paying less tax on profits going in, less tax on the investment earnings, and less tax on the capital gains. Those tax savings means you've had more money working for you the entire time. Now, there's a secret to this strategy that most accountants won't tell you. But first, you need to understand something really important. For this strategy to work, you need to reinvest the earnings and reinvest the capital gain within the company structure. If you want to take the capital gain out of the company, you're back paying the top tax rate and the strategy fails. Okay, are you ready for the secret? When you eventually stop working or scale back, that's when you start drawing dividends out of the company. Through the franking credit system, you can take out around $140,000 per person with no additional tax to pay if you don't have any other income. So you're not locked out of the money forever, you're just controlling when you access it, which is exactly what good tax planning looks like. Here's a real example. Husband and wife who have stopped working each take a fully franked dividend of $50,000. They also take a super pension of $50,000 each. The pension is tax-free, and because of the franking credits attached to the dividend, when they lodge their tax return, they each get an $8,000 tax refund. That's a total of $200,000 for the year, plus the tax refund of $16,000. Now, you should know that we're not getting rid of trusts altogether. A family trust can own the shares of the investment company, so you still get asset protection and estate planning flexibility. It's not a choice between a bucket company and a trust, they work together. But what about if you're not a business owner and you're holding assets personally? Well, the options are a bit different. If you've been thinking about selling an investment asset like property or shares, doing it before May 12 locks in the current 50% discount. That's not a reason to panic sell. But if you were considering selling it already, then the timing matters. And if you're not ready to sell, something we do with clients is plan for the sale during a year where they have little or no salary income. Maybe they're taking a year off, or they've just sold their business, or they're transitioning to retirement. Because you don't have a salary stacking on top of the capital gain, you avoid getting pushed into that top tax bracket, and the tax bill is significantly lower. So sometimes the best strategy is just patience and timing rather than a structural change. Look, nobody knows exactly what's going to be announced on the 12th of May budget, but the direction is pretty clear. If you're holding investments personally or in a trust, the maths is shifting against you. If you want us to look at your situation and work out whether your current structure still makes sense, there's a link below to book a call with our team. But if you're a business owner and you want to see how much tax you could really save using an investment company, watch this video here and I'll show you how I saved almost $1 million in tax using this exact strategy.